Hi, everybody. Welcome to the Middle Class Investor. This is Seth Martin, your host, and I want to wish everybody a happy Father's Day. We celebrated Father's Day on Saturday. Had a great time, and I hope all you fathers out there had a great time. And certainly, being a father is very important, and I hope everybody feels that is a father feels appreciated and feels like what they're doing as a father is important. I know it can be tough at times, but it's super important, and not enough men out there are being fathers like they should be. All right, well, today we're looking at this is the rising wedge. We've been looking at this for some time. This is the rising wedge out of the March 9th low, which was back here. And we've talked about how the price is narrowing and narrowing and narrowing to this point here, and that the probability of this move being down is pretty high. It's in the 90%. So we're expecting the market to break out of this, and generally speaking, this distance here, which is roughly 400 points, you should see the market correct about 400 points. So we're talking about into this 1500 range or so, which is pretty significant. That would put you, that'd take you back, basically wipe out all your gains for 2013, or almost all your gains in 2013 and 2014. So obviously we want to try to miss that. So what we're trying to do is to, basically time a decision. So middle class investor is all about, how do we make a good decision? How do we know when it's time to step aside? And last week I suggested that it might be a good time to take some profits. We could still get another high, but one of the things you'll notice, and we'll look at here in a second, there's not much left in any additional high. So we might get a sell-off down to about where we are, maybe even slightly lower, but probably not much below 1900. And then we could get a new high. And I'll talk a little bit about why I think that is shortly. But it does look like maybe we could get one more new high before we break out of this pattern to the downside. So that's kind of what we're expecting to happen. We'll play it by ear. We'll try to make a good decision. But we want to make a decision that keeps you out of the bear market, out of the sell-off. There's a saying in the market participants, that the elevator takes the market takes the staircase up, but it takes the elevator down. So you could have been patient all these years, all of 2013 and 2014, making your gains, and then in one little elevator ride down, you can get it wiped out. So we want to try to avoid that if we can, so that you can protect those profits and bank them, so to speak. Let's look at the interest rate, because that's I think what's driving, or what will be driving, a lot of the market. We talked about this being a potential bottom here, and if this is a potential bottom, then this is potentially the first move off the bottom. If this is the first move off the bottom, then we would have a correction back into this 2.4 area, maybe even slightly a little lower. We might not have actually made our low here. But then anytime you have a bottom and then an initial move off the bottom, the next move up is quite significant. Probably going to take us into this 5.5 area in the market. So we've been talking about, if you have bond funds, you want to be out of those bond funds. Preferably you would have used this move right through here to be selling those bond funds. Certainly you don't want to be in the bond funds as we start to make this next leg up into this area. You will lose a lot of money. So be careful about that. Let's look at the euro US dollar. This is another interesting market. The dollar has been strengthening against the euro since about mid-2012, albeit slowly. And I'm sorry. The euro has been strengthening against the dollar since mid-2012, but recently the euro. Let's zoom in on this a little bit. Recently, the euro has been pretty weak against the dollar. So this little move right in here looks like the euro got up to about 1.4 and then started selling off, and it looks like it actually broke through resistance here that I had on the chart, which just means that it'll go to the next level of resistance, which is down somewhere here below 134. So we'll look for that to happen. If it breaks that, we'll look for it to probably go all the way down here to the 126, 127 area. But this euro US dollar is probably the most important currency pair in the market. So we want to watch it closely. The NASDAQ, you can see that after the 2009 sell-off, the NASDAQ has made a really strong run-up. The reason I'm looking at the NASDAQ, let me switch here to a one-year chart. The reason we're looking here at the NASDAQ is it appears that the NASDAQ made its quote-unquote first move down, and this is the correction into that first move. If this does in fact roll over and go down, then this next move down should be quite significant. So we're going to be keeping an eye on that. Certainly, if this is down and this is back up, but to a lower high, as you can see here, it's a lower high than this high over here, and it breaks, let's say it breaks through this low right in here at 39.50, then we could be setting up for a trend reversal in the NASDAQ. And this and the bond market could be leading the entire market lower. That's what we want to kind of be on the lookout for. Let's look at the Dow, because the Dow had some interesting things happen in it. Same kind of rising wedge you can see here in red. And then we had another little rising wedge within a rising wedge in the Dow. And so you can see it had a strong move up, worked within this wedge, and then broke out of this wedge in what we call a throwover, and then quickly sold off to get back under this upper trend line of this second little wedge. There's kind of two possibilities at this point. The market could correct to a higher low, or excuse me, a lower high, and then sell off out of the wedge, or it could actually make another new high. But it's very rare when you have one of these little throwovers like this. This move is usually terminal. So normally what would happen is this will travel back up, say about 50% of this distance, or maybe a little bit more, and then sell off hard through here. So we'll look for that to happen. If that happens, then we can say that that's probably the first move down in a topping pattern. So we'll be looking for a correction back up to time our exit from the market so that we can be out at the next move down. So regardless of what happens, if this sells off hard through here, we're not going to panic and sell, although we could. There's nothing wrong with doing that. But likely what will happen is this will sell off hard through here. It'll make a return move that'll look corrective and overlapping, and then the next move down will be very sharp. And that's what will help us avoid this whole 400 point move in the S&P 500. So let's go to the S&P 500 and look at that. You can see the S&P 500 really only slightly broke out of its pattern, and also a throwover. So same thing we could look for here. Now the interesting thing about the S&P 500 that's a little different, and I think I have to let me go to a 60-day chart. You can see a little bit better, and I'll zoom in here. Let's zoom in nice and tight on this. Oops. Try that again. Okay. Now, here's our upper trend line, this red line right here. And here's our move in this throw over. Now, each one of these is an hour. Each one of these bars is an hour. But what you can see here is a gap. That's why I've got it marked here from 1649 and a half to 1946. The market gapped from the close here all the way to here and then sold off. It never really filled this gap. And gaps are almost always filled in the market, certainly at this high level. So I'm expecting the market to at least get back up into this 1950 area before it sells off. If it sells off, it could very well make a new high. But the nature of gaps is they typically get filled. So once the selling stops and we find a bottom, which it looks like we've done here, the market will make its way back up to fill this gap. Now, once it gets there, there's only a couple possibilities. It continues on through and makes a new high, or it starts to roll over and make a move down. So we're going to be looking for what happens as we approach this gap. It's going to be very critical. But the pattern is completed, or appears to be completed in this rising wedge. So just even though I'm on a 60-minute chart here, this is the lower trend line for the rising wedge, and this is the upper trend line for the rising wedge. So you can see that the prices moved from the low down here, kind of oscillated around the midpoint, and then made its way to the upper bound and actually broke out in a throw over a little bit before it rolled back over. So we're just going to look to see how the market corrects back toward this gap and see what it does. Does it go through the gap and on, or does it fill the gap slightly above it and then roll back over and start making a lower high? So we'll be looking for that. These types of things now are more important. We could draw another resistance box up here, but right now I think the most important thing to focus on is what happens when the market goes back up toward this gap. What does the price action look like? So we'll be looking for that. We'll look at gold real quick, but we're going to go to a different kind of chart for gold. This is a weekly chart, so each one of these bars is a week. And let me back up over here a little bit. You can see, the high. Let me zoom in here and see if I can grab the high. Not able to do it. It looks like it's outside. The high is up here. The high was around 1923.70 in gold, and you can't see it because it's off the screen, but it came down, made a low right here, corrected back up, and then made this really strong sell-off down here to 1180, 1179.40. It's been consolidating in this triangle-looking pattern, which looks like it would kind of do this. Now, typically, these triangle patterns are called trend continuation patterns. So the trend is clearly down through here. You have a consolidation, and then presumably at some point, maybe it comes back up here to this trend line and starts to sell off, but it should sell off and make a new low. This is not the low for gold, okay? Not for this trend that we're looking at, because this pattern you see right here, this zigzagging back and forth, is a trend continuation pattern. So to continue the trend, you have to know what direction the trend is. The trend is down through here. To continue, it's going to oscillate back and forth inside this triangle and then go lower. Now the question is how much lower. So we'll look for where gold tends to bottom, and it'll be a similar process. It shouldn't take this long. It could be a third of this time or something like that, but it'll come down, make a couple of attempts at a bottom, maybe not such a great range like this. Like it'll come down, make a bottom, and maybe only come up a little bit, hit the bottom again, maybe come up a little bit more, hit the bottom again, and then take off or something like that. So we'll look to see how that happens. But the low for gold is not quite in yet. So if you're thinking about going long gold, and you're a long-term investor, meaning you're not going to get in and out, you're going to kind of hold for months or even years, you want to wait for a new low, something below, probably below 1,000, at least below 1150, and then you can go long in gold. So that's what gold looks like. I think we've looked at everything. To me, the Dow is the most telling right now because it had such a this wedge within a wedge is such a unique deal, and these wedges tend to be trend termination patterns. So to have a wedge within a wedge is kind of interesting because if it actually comes to fruition and comes down through here, it'll make a low. The entire large degree first move down will take us down in the Dow to around this 15,200 area. And if that actually happens, then it's highly probable, highly likely that this larger wedge will then also fail. So let's just talk about that for a second. So what we would expect to happen there is you have this kind of zippity move down here to this 15,200 area, and then a correction back up somewhere in here, and then the next move down will be quite sharp. So these are going to be great opportunities to, if you're aggressive and you know how to short the market or buy puts, things like that, they're great opportunities to do that. But at the very least, it'll give us a great way to make a decision about when to step aside in the market, and that's really the larger goal of the middle class investor. So that's kind of my focus here. So I guess that's about it on here on Father's Day. We're just going to continue to watch this S&P 500. We have a gap that we need to watch. That's the Dow right there. The S&P 500 has a gap up around this 1945, 1950 area. So we're going to look to see how the market corrects back up into this area and what it does when it gets to that gap. That's going to be super critical. So will it make a new high, or will the gap, once it gets through the gap, will it turn and start coming down lower? So anyway, that's what we've got this week so far on the Middle Class Investor. Thank you guys for coming in. Don't forget to go to the YouTube channel, subscribe, follow me at Investor Class on Twitter, and tell your friends and family. Forward the link to the YouTube channel. My gut feeling is this will probably all be much more interesting if the market does in fact roll over and start going down sharply. I'm sure people are going to be wondering what to do at that point. But like I've been telling you now, you don't want to start formulating your plan when things are rapidly moving. You want to have your plan kind of formulated before things happen, and then execute accordingly. All right, well, that's it for this week, everybody. Thanks for coming in, and we'll see you next week. Thank you. Happy Father's Day.